Imagine for a moment that you invested $10,000 at the start of the new millennium in January 2000. The Standard & Poor's 500 index, which is the most popular benchmark for tracking the US stock market, is up over 565% from the start of 2000 to the end of 2024. That means your investment of $10,000 would have grown into $66,524. But here's the thing, investing isn't just a straight line up. In fact, it's far from that. Had you invested during that time frame, your S&P 500 fund would have dropped more than 50% in the late 2000s during the Great Financial Crisis. From the peak in October of 2007 to the bottom in March of 2009, the S&P 500 dropped 56.8%. Investing is essential to both protect and grow the value of your money, but it can be extremely stressful if you don't know what you're doing. So that's why we're going to be covering a crash course here on how to get started with investing as a complete beginner. Now guys, if you're new here and this is your first time seeing me, my name is Ryan Scribner and I've had a lifetime passion for personal finance. I post weekly videos here on the NerdWallet YouTube channel, so make sure you both subscribe and hit the bell for notifications. And real quick guys, I am not a financial advisor and this is not any kind of personalized financial advice. Before we cover the how of investing, it's important to understand the why behind it. A lot of people think investing stems from the desire to have more money, but that's only partially correct. Yes, investing can help you grow your wealth. But investing is just as important for those who desire to have the same amount of buying power tomorrow as they do today. Let me explain. Each year, your dollars are buying you less and less of something, and that is because of a phenomenon called inflation. So if you leave your money sitting there in the bank, earning little to no interest, you're going to be losing buying power to inflation. Now, the Federal Reserve does have a target inflation rate of 2%, and the latest inflation reading for December came in at 2.9%. That means your first goal as an investor is going to be earning a return on your money that exceeds the anticipated inflation rate. If you expect inflation to be about 2 to 3% annually, you'll want to make sure you're earning at least that much as a return on your investment or yield on your savings. But beyond just protecting your buying power, the long-term goal of investing is to grow the value of your money beyond what is lost to inflation. The S&P 500, which is the investment we covered in the intro, has returned 10% on average per year for nearly the last century. That means those who invested in this fund over the long run both protected their buying power from inflation and grew the value of their money over time. But just like we saw with the greater than 50% decline during the Great Financial Crisis, there are boom and bust cycles in the market. And guys, real quick, if you've gotten any value out of this video so far, please drop a like. Now that we understand why investing is so important, we're going to cover some of the easiest ways to start investing today. The good thing is, thanks to technology, it's easier than ever before to begin investing today. Trading commissions are largely a thing of the past, and fractional shares have allowed for minimum investments as low as $1 in some cases. Speaking of tech, there's a lot of sophisticated math and algos involved with this first easy method for beginning to invest, and that is robo-advisors. As the name suggests, a robo-advisor is basically a software that helps people invest their money without needing a human financial advisor. This makes things far less expensive as there is very little human involvement. In addition, this also allows for much lower investment minimums. A robo-advisor will ask you questions about your financial goals and risk tolerance, and then it uses algorithms to create and manage an investment portfolio for you. This portfolio usually consists of stocks and bonds, but it might also include alternative investments too. Robo-advisors are a great option for those who are looking for a long-term, set-it-and-forget-it approach to investing. Everything can be fully automated, and the cost savings of having less humans involved are usually passed along to the clients in the form of lower asset management fees. But one con about using these robo-advisors is that many of them do not offer any human financial advisors as part of the package, and this means you might not be able to talk to a real person about your investments. When researching different robo-advisors, it's important to understand that each one is going to have a different fee structure and overall strategy, so just make sure you fully understand this before you begin investing. Now, for those who are looking for a bit more control with their portfolios, we have the next easy way to begin investing, and that is ETFs. ETFs. Exchange-traded funds are collections of different assets that can be bought and sold just like a stock on the major exchanges. If we revisit the S&P 500 investment example from earlier, an S&P 500 ETF is what you would actually use if you were following this strategy. That means when you invest in an ETF, your money is split up across all of the different components of the index. As a shareholder, you own a portion of the fund, and that fund owns shares of all of those different companies in the case of the S&P 500. ETFs come with many benefits, but perhaps the biggest is having built-in diversification. In fact, robo-advisors will actually use these ETFs in most cases as the investment vehicles when constructing their portfolios. If you decide ETFs are a good fit for you, keep in mind you're going to have to figure out your portfolio allocation and make changes to this over time. And finally, on our list, we have stocks. While this investment can be riskier, some people may want to pick and choose individual companies that they want to own shares of. For example, if you're an avid user of Apple products and want to own a piece of the business, you can go out and buy Apple stock. Not all companies out there are publicly traded, but many of them are, and this means that you can buy shares of them. But just keep in mind that investing in individual stocks is going to be a lot riskier than the diversified investments we covered earlier on. That's because the outcome of the business will directly impact the shareholders, good or bad. And when you own individual stocks, you usually end up putting a lot of eggs in one basket or money in one stock. If a negative business outcome pushes the share price lower and you own a lot of shares, this could lead to substantial losses. So just understand that while stocks might be considered an easy investment, easy doesn't necessarily mean low risk. So let's say you want to get started with one of these 3 investment options on the list. If you're looking for a robo-advisor, here's a few options you'll want to consider. Wealthfront is a popular choice, and it's the highest scoring robo-advisor according to NerdWallet. This robo-advisor offers both DIY and automated investment options, which makes this a good option for those who want to explore both. Another robo-advisor worth looking into is the Vanguard Digital Advisor. The account minimum for Vanguard is lower compared to other providers like Wealthfront, and the fees are among the lowest in the industry. Be sure to check out the full robo-advisor's guide on NerdWallet, linked up in the description below to learn more. If you're looking to get started with investing in either stocks or ETFs, you're going to need a stock brokerage account for either option. NerdWallet recommends options like Fidelity and Charles Schwab that are time-tested, but also recognizes newcomers on the block like Robinhood. You can learn more about all of these and more by reading the Best Brokerage Accounts for Online Stock Trading Guide on NerdWallet, also linked down below. There you have it, guys. Those are 3 easy investments to get your investing journey started with. The biggest thing to keep in mind as you continue on here is that it's important to build a plan that works for you and your goals over the long term. Comparing the amount of money that you're investing to somebody else isn't the point here. It's all about you. And keep in mind too that you can always start off small and scale up your investments over time as you get more comfortable with it. Be sure to leave us a comment down below with your favorite piece of investing wisdom. For me, it's this quote from Warren Buffett: "Price is what you pay, and value is what you get." If you're wondering whether or not this is the right time to be investing in the first place, be sure to check out our full video on saving versus investing. See you next time.